Before explaining this entry model, we need to mention that we use a very specific time frame and time zone to look for trading opportunities in the Silver Bullet trading setup. The time frame for this setup is a 5-minute chart, and the trading time window spans from 9 p.m. New York time until the end of the day. In other words, we look for trades starting an hour and a half after the New York session opens until the end of the trading day. Here is how we prepare our chart for analyzing the market structure in the Silver Bullet trading strategy. Open any chart on TradingView.com and set the time frame to 5 minutes. Select the Indicators tab and search for Sessions. Click on the indicator called Sessions on Chart, provided by Aurochs. This indicator shows all the sessions, so we need to make some adjustments. In the Settings tab, uncheck the Tokyo and London sessions and change the beginning of the New York session to 9:30. We also need to enable the period separator on the TradingView platform. Right-click on the chart and click on Settings. From the Events tab, select Session Breaks. Vertical lines dividing each day will now appear on the chart. Here, the red box indicates the time of day we will look for trading opportunities. The blue lines separate each trading day, and the empty space represents the London and Asian sessions. The high and low of the day during the London and Asian sessions is extremely important in the Silver Bullet strategy, which we will discuss later. So basically, the first step in the Silver Bullet strategy is to set up a chart and define the trading hours. The next step is to identify a specific trading model on the chart. In this trading model, the price first breaks above the day's high and sweeps the liquidity. This means that the market has targeted the liquidity above the most important structure of the day, which is the highest price traded during the Asian and London sessions. Next, we witness a bearish market structure shift, signaling a possible reversal to the downside. This is a strong confirmation that the bullish movement is over, and we might witness a reversal as sellers are now in control. At this point, we look for a fair value gap area as our optimal trading zone to enter a short position. The psychology behind this trading model is that the algorithmic price delivery pushes the price above the high of the day to engage liquidity by trapping traders. Then, smart money goes short to engage the sell-side liquidity, which is below the lowest price of the day. First, we observe a bearish breakout below the previous low, indicating a potential reversal. The fair value gaps that form after the market structure shift are considered our supply area for going short. The same concept applies to the bearish scenario. We want to witness a penetration below the low of the day, followed by a market structure shift to the upside. This indicates that the algorithmic price delivery has swept the liquidity below the most important structure, which is the low of the day, deceiving traders who thought the price would continue to decline. After engaging the sell-side liquidity, smart money will target the buy-side liquidity, which is usually the high of the day. The final and crucial step is to identify the fair value gap as our entry area to go long. So basically, the second step of the Silver Bullet trading strategy has 3 milestones. First, wait for the price to engage the liquidity above the day's high or below the day's low. Second, identify a market structure shift to confirm the reversal. Third, identify the optimal trading zones, which are the fair value gap areas. Here is an important point. If even one of these criteria is unfulfilled, we won't take any trade. We simply wait for another trading day to implement the Silver Bullet trading strategy. Now we move on to the third and final step, which is executing the trade. As mentioned earlier, the FVG areas are our optimal trading zones. Therefore, we mark them on the chart and look to execute trades when the price pulls back to these areas. For example, in this scenario, our latest impulsive move started from this point and extended all the way up to here. We can identify 2 fair value gaps within this movement. The market typically seeks to return to these areas to reconcile imbalances, and when it does, these areas will act as support, pushing the price higher. But here's an important point. We're only interested in buying in the discount zone and selling in the premium side of the retracement range. If we apply the Fibonacci retracement tool from the start to the end of this move, The area above 50% is considered the premium, and the area below 50% is the discount zone. So our focus is solely on trading within the lower FVG due to multiple reasons. Usually the market loves to take out the early buyers. So, a more conservative way to enter the long trade is to wait for the price to enter the discount. This increases the chance of success and reduces the chance of being the victim of a liquidity grab. Also, we would have a greater risk-to-reward ratio on this trading opportunity, which is extremely important. This is our trade execution strategy. We'll set a buy limit at the beginning of the FVG zone and place our stop loss below the first candle of the 3 consecutive candles that form the FVG. To secure our trade, we'll make it break even by closing half of the position once the price reaches our 1 to 2 target. This way, even if the price retraces and hits our stop loss, we'll be at break even and won't lose any money. Consequently, we can maintain our position to maximize profits without feeling pressured. For the second target, we can either aim for double or triple what we've risked, or target higher timeframe key levels. The same is valid for the bearish scenario. After identifying the fair value gap, we verify if it is situated on the premium side of the range. If it is, we'll set a sell limit at the beginning of the FVG zone and place the stop above the candle that formed the FVG. We'll target the same objectives as in the bullish scenario. Now let's see some backtesting results on the euro-dollar currency pair. Here we have the recent week on this pair. As we already mentioned, the red box shows the time of the day. We look for trading opportunities, which is 1 hour and a half after the New York opening. The first thing we mark is the high and the low of the day before New York opening. Here we can see that the price has broken the day's high to the upside and engaged the buy-side liquidity. Then the price has returned inside the range immediately. Now this can be considered a liquidity grab movement. However, we need a market structure shift to confirm our reversal. The market structure shift has occurred here by breaking below the demand area, which shows a bearish momentum. This happened after multiple weak bullish movements. This movement has also created multiple fair value gap areas that are our supply zone to go short. However, by applying the retracement tool, we can see that only this one is inside the premium side of the range. So we are only interested in trading this FVG. Let's see the next day. Here we have another perfect trading opportunity. The market has swept the liquidity below the low of the day and immediately got back into the range. We had a period of consolidation, and then the price broke the R to the upside with imbalance, causing multiple fair value gaps. If we consider here the start and here the end of the impulsive movement and apply the Fibonacci retracement levels, we can see that only the lower one is located inside the discount side of the range. So this makes our optimal demand area to go long. Our stop will be below the fair value gap since we have a large zone, and we will set our targets according to the strategy. Let's see the next day. Here, before New York begins, we had a liquidity run above a strong level of resistance. Just look at how many times this level has been tested. If we consider breaking below this extreme demand area a shift in market structure, we would have had a great trading opportunity at this FVG zone. But the price could not pull back to that area due to massive selling pressure. Following, we still could have gone short with the selling momentum, but we can't identify any particular FVG above the 50% retracement level. So we have a missing trade. In the next part of the video, let me introduce another setup for the silver bullet model, similar to the first one with one major difference. It is the same combination of liquidity sweep, followed by a market structure shift with an imbalance. But the difference here is that this liquidity sweep happens inside the New York session. So the same exact rules are valid for this trading setup as well. Here on the euro-dollar 5 minutes chart, this is the low and high of the day during the Asian and London sessions. Although the price did not swipe these key liquidity areas, if we look at our trading hours, we can identify the silver bullet trading model. The price has swept the liquidity above the highest level that was created in the New York session. We have a market structure shift which shows a possible reversal. The latest move has created a fair value gap which shows a bearish momentum. Now, if this FVG was located inside the premium side of the retracement range, we could enter a short position. The psychology behind this setup is the same, with only this difference that the price tends to grab the liquidity above the recent structure in the New York session. Keep in mind that when opening the positions, sometimes the fair value gaps are located on the 50% retracement levels. So here comes a question. How do we set our entry in this scenario? In this case, we only consider the side of the FVG that is inside the discount zone as our optimal trading area. We set our position at the 50% level and set our targets according to the trading plan. But remember, since we have a very tiny demand zone, we need to keep our stop loss large. This FVG area is an optimal place to open a buy position, but being rejected exactly from this box is not a law. The market can easily ignore this area and reverse from lower prices. Therefore, for the large trading zones, we use a small stop loss below area. And conversely, for a small trading area, we use a larger stop loss below the area. Remember, trading on the live chart involves real money and real emotions. It's a whole different game compared to paper trading or simulation.